This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Interested in learning more about investing in startups, launching a new startup and need to raise funding? The Startup Funding Espresso is a daily podcast in a short, concise format delivered to your inbox every day, Monday through Friday. In the time it takes to drink an espresso, you can learn about startup funding. To subscribe, go to investorconnect.org and put your email into the pop-up box. Hello, this is Hall Martin with Investor Connect. Today we're here with Ron Thompson, CEO of CAIL. CAIL provides software to enterprises for connectivity, security, and to modernize information services. Ron, thank you for joining us.
Thank you.
So what was your background before investing in early stage companies? What did you do before?
Well, I started off my career for a number of years in big enterprises. So you can kind of see how they use technology. I was a computer programmer in the early days, and then I got involved on the business side with pricing and making the market and all that kind of stuff to enable people to benefit with technology. So I did that for about 10 years. And then I was a founder of CAIL. So I'm a founder. So when we do venture investing, it's easy for me to relate to founders because that's what I was in the beginning and having a technical background. So you've got this way of relating to these founders to help them understand what's in front of them, as well as provide the money and so forth to help them scale their business and be successful.
Well, that's great. So what excites you right now?
There's a number of things. We have a real interest in fintech and prop tech. Fundamentally, we like young technology companies have a service or a product of interest to enterprises. So basically, if the Bank of America or JP Morgan Chase or US Foods or any other big organization would find your platform or service of interest, then we would have an interest in supporting those entrepreneurs. And so we like that because there's a real need for these enterprises to innovate better and to fast track delivering new services and capabilities, improving efficiencies, and fundamentally transform over time. So to do that, to have any platform show its value, to show the magic, you need data. And so all these platforms need access to data. And with the core CAIL software business, that's what we do. So if founders need insights on how to access these internal systems in enterprises, we can give very detailed insights about that and work with them to actually expand their connectivity capabilities to make their platform even better.
Great. And so you see a lot of startups and a lot of investors out there. What's your advice for people investing in startups? What do you tell them to do before they write that check?
There's a lot you need to do. Due diligence is really important. Thing about this, there's two aspects to this. Actually, there's three main ones. One is the value of the technology and the opportunity, the uniqueness of it, the business benefits it delivers. That's one. The other deals with the founders, the people. This is a huge component. So basically, are the founders good to collaborate with? Do they listen? Do they seek advice? Do they seem serious about success and hell-bent one way or another to make it happen? And that means evolve the product, have high stickiness with it, and articulate a very compelling value proposition and how you're delivering important benefits on business terms. So that's the second. The third gets into the other investors. So basically, we're big believers in investor value add. So basically, if you don't provide value add, it's dumb money. So because they can't get money from a bank, they come to us. But the attitude is the same, and that's very problematic. So when you get involved with investors like CAIL and others who have knowledge and connections and value add, the founders need to be very aggressive pursuing that knowledge, picking their brains, and trying to leverage this brain trust they've got at their disposal to improve understanding of the landscape, where the opportunities are, what kind of metrics, what kind of, issues there could be in the making and so forth. And fundamentally, where are the risks and how do we mitigate those kind of things? And so if you have some good investors who provide value add, you have a treasure trove of knowledge to really help you learn fast and to improve the chance of the business being successful. And in the end, it's all about managing risk. And these three main things to get a handle on when you're looking at investments is really important to understand that stuff so you can make your own assessments where the risks are, where the issues are, and how to mitigate these things and benefit by the knowledge of others, the founders, as well as the other investors, to fast track understanding how to scope things out and put things in the term sheet around contributions, but also terms, like what triggers reviews. And at some point, there could be a thing with a change in the leadership team or a change on the board of advisors or things like that. Or because someone brought in a great partner, that kind of changes the dynamics. Well, how can we encourage more of that to happen to further fast track progress and reduce risk?
Great. Then on the other side of that table, what's your advice for founders who are going out to raise funding? What do you tell them to do before they launch that campaign?
Understand the mindset I just articulated. So that, and basically this is very challenging for founders who tend to be young and very technology centric. So, you really can only be good at something. So if you're an excellent programmer, you should be grateful you have that talent, because becoming a successful company involves many things, is why you need this leadership team with these other competencies at a very high level so that you can decide not just on technology and technology strategy and direction, but also the business, and the finances and building out the support organization and working with the investors and on trying to find good partners, how to build up ecosystems with other technology firms and other business partners. So there's a whole bunch of things that you need to understand about this kind of stuff. So between the internal team having these competencies, then you need to have advisors who can complement you and further add to the knowledge base.
Great. Let's talk about the state of startup investing. How do you see it evolving from here? Where do you see it going?
It's a good question. Startup investing in many ways has not changed a lot over time, except for there's so many more ventures now, so many more markets, and so many more tools to fast track getting to market. So compared to 10, 20 years ago, in theory, you should be able to get to market much faster, much cheaper, and make decisions to pivot sooner than later and all that kind of stuff now. So if you get onto something good, you can scale it much more easily now than before. So that's something to understand. And that's when we talk about building out ecosystems around the product, but also around on the business side and go-to-market capabilities, so that you got this window of opportunity. And the idea is to get into it as soon as you can and evolve it as fast as you can to maximize the potential before it closes.
What do you think is the biggest change we'll see in the next 12 to 24 months?
The windows of opportunity opening and closing faster. And because of that, there's a real need for a sense of urgency by the founders, as well as the major investors, to really get a fix on what the opportunity is, what people are looking for, and so forth. And so can you put yourself in the shoes of a purchasing agent or of someone in an enterprise in some business unit trying to achieve something and things like that? So you need to be able to not only know your own stuff, but also put yourself in their shoes. So when you talk to them, it's on their terms and they understand, and so forth. And I work with other investors to try and help figure that messaging out. And even when you engage, maybe they're part of the team, so that they can see they've got the technology people in the room and some of the business people in the operations, but also some of the advisors who come in because they've got background in this space and they can talk about evolution and transformation from a business perspective from several decades of experience. And that's important to build credibility with the potential buyers, that not you have a good product, but there's context here. And they can see, here we are now, 5, 10, 20 years out, these are the kind of capabilities that we need, both in terms of tools, but also the brain trust around it that will make it even better and expand our opportunities and reduce our risks to evolve the business. So the more you can do to kind of bring that together, the better.
So let's talk about your investment thesis. What is it, and what's your criteria for choosing one deal over another?
Well, part of it is what I've already articulated around the technology, the platform, the market opportunity, the founders, the other investors, this brain trust that forms things like that. And so you kind of get into this where as much science as it is art. And the more you get into something, it's an interesting combination. Like, for example, Paul McCartney can't read or write music, but he can do great tunes because he's very sound oriented. And it turns out a lot of people who are naturals are like that. And so people like Bill Gates, Steve Jobs, and all the others that came along had these early visions, got the 10,000 hours in early, have a huge advantage in doing this. And rest assured, those people had some really good advisors around them and made some really smart moves because of the way it was set up. And what can you do to get yourself around good people like that and create a good forum to improve your chances of success? So we look for ventures that those founders kind of understand that kind of stuff, or they're asking questions to help themselves learn how to play the game.
Can you talk about one or two startups that maybe you funded that fit that thesis?
You don't find it in totality out of the gate. You see some things that, the person gets it. Other things, you hope they will get it. And so what we do is we will send in questions, or we will forward things that we see from the news that could impact their business. And we'll ask them, so could this be something that you guys should check out, or check these guys to be a partner out? Or is this a potential customer, or some other way it could impact the business? And we see if they respond in kind to that suggestion. And you would not believe how many times you're blown off. So we do this before we write checks, just to kind of gauge attitude. So you're looking for aptitude, attitude, competency, being serious about success. And also, that's a shared understanding of what success means. I've seen founders, when they got 100 people, they view that's being successful, even though they're burning a whack of money. So I look at success, you got to have a bunch of people, and even if you're running a deficit yet, you can see that it's going to end at some point and become a highly lucrative business as it scales. Now, everyone knows this is the theory. Interesting, when people get into try and make it happen, they raise a few $1 million. It's amazing how many founders kind of start, thinking they're it. And this is a great thing. They have their empire, their people, things like that. And that's all that really matters. So it's very self-centric. It's very, it's just whatever, but it's not business. And so the fundamental understanding is when you start taking money from people like me, it goes from being a hobby or family concern to becoming a business. And when the VCs get involved with the later stage rounds, it better be a business, because they look at the whole thing on the business model, the market opportunity, and they insist on kind of like certain veto rights or certain presence and things at the board level, and. So the sooner the founders understand that's how the game evolves, and the sooner you kind of get onto it, the better it is, because then you're all on the same page. And a big thing here is being on the same page, learning fast, evolving, and being very entrepreneurial and opportunistic. And working that brain trust to figure it out and know how to test and pivot and push.
So what do you think is the main challenge startups face in today's market in launching their business?
Like they've always faced. They don't know what they don't know. And many times they don't want to know. So we look for this in our due diligence. And it's basically, it's attitude. And some people they just don't know. They don't really, they want to do it because their friends talk about it and it's cool. Or to be an entrepreneur these days. it's cool. It's a thing to do. Whereas 50 years ago, to go work for a big corporation was a thing to do. Mm-hmm. So the definition of success, the aspirations, and what people, get them going has changed. So these days it's entrepreneurship, and they see all these things getting done in technology, and they all figure they're the next Bill Gates. And I can tell you, there's one Bill Gates. So you figure out how you can be unique and how to help to have this mindset and learn a lot and to, be able to contribute and for the business to be successful.
So what are the challenges investors face in today's market?
Lots of investment opportunities, tons. Yeah. Like, for example, in the fintech sector alone, do you know how many young companies there are?
How many?
About 10,000.
That's a lot of deal flow.
It is. And it's all over the world. And all these incubators, accelerators. And the way you got to look at this thing is that there's 10,000 fintechs, kind of like 10,000 gnats on an elephant. And this is what the banks are facing, because these fintechs will target a specific area of financial services, student loans, corporate loans, personal finance, other things, in the sharing economy, stuff like that. So even though that one area, when it gets lost to the bank, is not an issue, but if I have 10,000 tech companies doing something, and let's say 50 make a go of it, chances are in aggregate, I got a problem, even if I'm Bank of America. That's the issue they have. And it's cool. Then you look at it, let's say there's 10,000 gnats on an elephant, most won't do any damage. But over a time, a few will get through, and in the end, the elephant's going down. There's just too many. And that's the same thing with the fintechs. So the reason that we look how we look at this is that these enterprises need to be much better at innovation, business innovation. So one of the reasons we started the innovation practice here at CAIL is we saw the challenges with these startups trying to get enterprises to buy their stuff. And we looked at it and like, what's going on? It's obvious. But, these big enterprises, like, who do you target? And they got to get a committee going, and they got to get buy-in, they got to do that. And of course, if the business has one set of needs, IT looks at, this is more work and whatever else it is. So it's just challenging to get things done. So we formed this innovation practice that if a startup has an opportunity and for some reason the sales is not progressing in enterprise, maybe we should target their management about innovation and having the mindset about how to be more open and how to be more opportunistic, more entrepreneurial, and. And to cite this fact, like these 10,000 fintechs. If you reject this guy, you reject the next guy, at some point, you're going to have an issue because you're not really changing. You're not doing the new things. And what's happened is all these fintechs are going direct. So you're going to either not see new customers or worse, lose current customers. And so you need to have this mindset around how to deliver value and become much more digital sophisticated and much more responsive and opportunistic, and realize that when you do these new things is that 1 in 10 might be a success. But if I don't try the other 10, the other 9, I'll never find the one. And I got to do that probably on a annual basis. And the reality is I might need 100 or 500 or 1,000 ideas to have 10 things to go do a pilot on, and maybe 1 or 2 of those things pans out. So there's a whole mindset around how to innovate for impact. And once you get onto that, then looking at these startups and working with them is like a no-brainer. Otherwise, they sit there and they navel gaze and the value of indecision, and things don't happen.
Well, great. So we've talked about a number of applications and sectors today, but if you had to pick 1 or 2 of them that were really good opportunities for investors to pursue, what do you put at the top of the list today?
Oh, geez. Actually, there really is no one area that is meaningfully better than another. We like fintech, we like prop tech, but there's, insure tech, there's ag tech, there's a lot of stuff in biotech. The whole healthcare field is huge, and. So healthcare is interesting because there's such a need for the new in health tech. But the blockers to adoption and is huge, both mentally with the establishment, the costs, and. So it's just very problematic to affect change in healthcare or in government. And in fact, the larger the organization, and the more entrenched the industry, the more challenging it is to affect change. And so these young tech companies come along and they see these great big Fortune 500 companies. And they just look like whales just taking in the money, and there's nothing going on there just because they've been around 100 years. And they look at that, holy cow, and look at what Robinhood did for trading. And look what a bunch of other companies have done, like Amazon for retailing, and Apple for music, and Uber for transportation, and Airbnb for accommodation. Like those are just the early examples of established industries changing, and they're just getting started. So you look at that, like even with Uber, now the whole thing around electric is coming in. So the whole transportation sector is further changing. And what are the chances of the major auto companies being players 25 years from now as this market continues to segment and these new things keep coming up, and it's all technology driven? They're working hard to do it, but it's not the mindset of management. And furthermore, the senior executives in these big established companies don't have a technology background or understanding of digital or feel for it. And they're being asked to commit millions and billions to new digital initiatives. How do they decide? Very challenging. And that's why we try and get in there with them with this innovation practice to explain this kind of stuff and give these guys a chance. And yeah, there's going to be failures, but I got to find the one. And I got to find another one. And over time, I'm making that, easier and better to be more successful. If I don't get onto that path, at some point, I'm going to be either bankrupt or bought. Mm-hmm. That's the situation. So it is what it is.
It is. So in the last few minutes that we have here, what else should we cover that we haven't?
I'd like just to talk on risk, the changing nature of risk. So I got some friends who are quite senior with some big companies, and their notion of risk is based on decades-old concepts. They're into established industries, tangible products, and. And they look at, if I make incremental changes, evolve that product, and, I can evolve my core. And that's what they feel comfortable doing. However, because of all the emergence of digital, rising user expectations, the whole, business landscape is changing, and, is the nature of risk is changing. It's got to the point that if I don't try, it's actually riskier. It's actually riskier to not try than try. So I need to be trying. And the more you can have people around you that have a shared vision of where we're going to go here and can contribute with different domain knowledge, insights, and, then you can better manage change, be more successful transformation, and over time, reduce risk. And you have to ask yourself, what do I want to be doing in 5, 10, 20 years from now that people want to deal with me? How can I increase relevance and revenue? And if you talk to the senior executives and it gets into, those new services, new capabilities, and the user experience, these people struggle with even how to relate to that stuff, let alone how to deliver on it. So that's why the big enterprises are vulnerable to fintechs and to other technology companies. So I would advise, if you really want to manage risk, you've got to develop this digital mindset, this digital competency, and partner more aggressively with these technology companies and do it at a peer level. Not because you crank 100 billion in revenue and they crank $1 billion, therefore you have the say. No. If you think that's how the game is played, you wait 5 or 10 years and the numbers will be reversed. And so you have to understand that's the nature of the business landscape, the emergence of technology in it, and the whole mindset with the people involved in making these things happen. So if you want to be successful, understand the changing nature of risk.
Well, that's a great advice for all startups and investors out there. How best for listeners to get back in touch with you?
The easiest way is to send me an email to rthompson@CAIL.com. or go to my LinkedIn profile and you can see more information there. So it's Ron Thompson with CAIL.
Great. We'll put those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Very good. Good talking to you. Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halty Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.